what are all the sort of contributing factors that's driving this extended slide now?
Yeah, so commercial real estate loans have been a concern since COVID when work from home policies continue to weigh on the commercial property values. But what triggered this round of sell-offs of Community Bank is that when this bank reported earnings on January 31st, it kind of splashed its dividends and stockpiled a lot of reserves that intensified the market fear. And what is special about New York Community Bank is that it is actually one of the winners of last year's regional banking crisis when it acquired loans from Signature Bank that pushed up its asset over $100 billion, which also made it subject to more regulatory scrutiny in terms of its liquidity and in terms of its commercial real estate concentration. And the company also reported 2 charge-offs in its commercial real estate loans. One is office, another one is a co-op loan, both are in New York. It also has some exposure to the rent-stabilized loans in New York, which is subject to a lot of regulations that kind of adds to the concerns we're seeing here.
Yeah, we just heard from Janet Yellen there expressing some concerns about commercial real estate. But what else are we hearing from regulators and as well the 2 NYCB executives that just left?
Yeah, so one thing to keep in mind is that New York Community Bank almost doubled its size over the past 15 months thanks to its acquisitions of Flagstar, its mortgage unit, and its takeover of the Signature Bank loans. So because of that, it attracted some regulatory pressure from the banking regulator OCC, which has been exercising some control over its dividend payout after the acquisitions. And we have a story yesterday about the bank's chief risk officer and its chief audit officer left before the specific measures with the regulators are reviewed. Right now, we do not know if the management pushed them out or if the regulators prompted them out, or they just simply choose to leave. But it's just very interesting to see it happening from a risk and compliance perspective.
We're still haunted by what happened with SVB last year. Should we be looking out for more risks? Is there depositor outflow pressure like we saw with SVB? And we've seen, a similar pressure with Azora in Japan, right? Is this a bigger kind of picture situation when it comes to risks within these portfolios?
So right now, the company didn't share any details on the deposit outflows. So we're also waiting for more clarities on that. But when we look at its balance sheet, it does seem a little bit vulnerable because a third of its deposits are uninsured by the FDIC. And it has been relying on the broker deposits to beef up the liquidity. And apparently a lot of the money is the demand deposit accounts, which can be withdrawn at any time without notice. And another thing we're closely watching is any activities in the bank's balance sheet management, meaning is the bank going to sell off some line of its business or shrinking its bond or loan portfolios or do some sort of the credit risk transfer with private equity or hedge fund that can help them inject some capital.